Hello and welcome to International Finance presentation. Today we'll be discussing 5 topics: the Marshall-Lerner condition, Dumbush's exchange rate overshooting model, purchasing power parity in the long and short run, options and futures contracts to hedge against foreign exchange risk, and finally, financial institutions and innovations in managing the impact of COVID-19 on the economy. Topic 1. The Marshall-Lerner condition. In this section, we will evaluate the Marshall-Lerner condition and currency devaluation with relation to COVID-19 and the current economy. Previous research has defined the Marshall-Lerner condition, concluding that it will only occur a country's balance of payment deficits if the sum of the import and export prices is greater than a value of 1. Some studies have found that the Marshall-Lerner condition has held, and other studies have found that the Marshall-Lerner condition does not hold for other countries, such as Nigeria, who are import dependent. The Marshall-Lerner condition only works for countries that have a similar amount of imports to exports, since this leads to higher elasticity. If a country focuses mostly on import or mostly on exports, with the other being very low percent, a low elasticity is common, making the Marshall-Lerner condition ineffective and will not improve the country's trade balance. Topic 2. Dumbush's overshooting model. In this section, we'll discuss the main feature of Dumbush's exchange rate overshooting model and explain its contribution to our understanding of the main causes of exchange rate volatility. Overshooting is a way to explain the increase in volatility in exchange rates. Exchange rate volatility can be defined as the risk to do with the unexpected change in the exchange rate. Some studies have found that the exchange rate has not been affected, even though we are now in a global recession again. The 2008 recession was much worse. One of the main causes of exchange rate volatility is inflation rates, as it affects the country's currency value. If you look at the graph below, you can see between 2017 and 2020, the euro-US dollar versus the stock market volatility, but you can see that COVID has not really had an impact on this. In conclusion, there are few things that can impact the exchange rate volatility, and for research thus far, it can be concluded that COVID hasn't had much an effect on it, unlike some of the other factors mentioned. Topic 3. Purchasing power parity. In this section, we'll discuss the usefulness of purchasing power parity in predicting movements in foreign exchange rate in terms of the short run and the long run. PPP is when the differences in cost of living and the inflation rates are taken into consideration to equalise the purchasing power of two separate currencies, meaning if you buy an item in one country, it should cost the same to buy in another country. It's said to be a good measure for the long run compared to the short run. This is due to there being many factors that make PPP highly volatile in the short run. Tax differences, government intervention, and transport costs for global trade are just some of these factors. The answer is in the literature. Many studies have found that PPP is more useful for the long term compared to the short term. Studies by Hakio, Abu-Fanjorian, and Mansour and Arif have all suggested that PPP does not hold as well in the short run compared to the long run. Whereas Taylor and Taylor and Sidiris have all found that the long run also is much better at using PPP. To conclude, COVID-19 is still unforeseen and highly unpredictable. So any predictions using PPP at this time should be taken with a pinch of salt, as the findings show that it's not so useful at predicting movement in the foreign exchange rates for the short run. So with COVID being a main cause for changes in these factors, then this should be taken into consideration when using PPP, as the volatility was most likely even out in a few years when COVID settles down. Topic 4. The usefulness of options and future shares. This section will discuss the usefulness of options and futures contracts to hedge against the foreign exchange risk relating to COVID-19. The key categories of stock derivatives exchanged on the equities market are futures and options. An option on a futures agreement is somewhat similar to the stock option because it allows the purchaser to buy or sell the underlying assets and at the same time gives the seller a potential duty to purchase or sell the underlying assets of the purchaser once this option. Hedging is when two parties enter into a contract with predetermined exchange rate as to minimise risk to both parties. Futures and options contracts use hedging as a way to minimise the risk of fluctuating foreign exchange rate in this way. The use of option contracts will be able to reduce the effect of exchange rate changes on revenues and operating expenses due to economic breakdown. Also, future contracts will provide an effective hedging as it will be able to maintain the supply of currency and can decide how much of this currency to hedge. Overall, options future contracts are an effective way of hedging against foreign exchange rates as they are able to minimise the risk that a company faces and lessens the cost loss from an event if it happens. Topic 5. Financial institutions and international market risk management. In this section, we'll assess how financial institutions and new innovations relating to the COVID-19 pandemic have impacted the UK economy. This will be done by discussing risk management techniques and how they help protect against changes in the foreign exchange and financial markets. Since COVID-19 has broke out, thousands have lost their jobs, there is mass unemployment and a nationwide economic depression. However, there have been several ways in which financial institutions have attempted to combat this. The primary risk management technique utilised by the UK economy was the use of the financial derivatives to help against interest rate risk and exchange rate risk. There are two types of derivatives that were particularly beneficial during the pandemic: swaps and forwards. What are swaps? A swap is a contract involved in one party exchanging the value of one asset for another. It utilises a fixed value asset with the underlying asset of the contract fluctuating to influence the value. So these contracts are designed to match the volatility of international capital flows, and because of this, they were utilised to take advantage of the change in currency values during the pandemic. What are forwards? A forward is very similar to a future in the sense that it is a contract where two parties agree to transfer a certain amount of goods or commodities at an agreed upon price at the end of the contract. The main difference is that forwards are traded over the counter instead of in an exchange, which allows for further customisation of the contract size and length. The reason why forwards are so valuable in the currency market during the pandemic can be explained in this example. These conditions would allow the UK economy to benefit during the difficult times created by the pandemic by profiteering from these deals. To conclude, derivatives were a particularly useful technique that the UK's financial institutions were able to benefit from during the pandemic by protecting against interest rate and exchange rate risk in the international markets. With this in mind, they should hopefully be able to use the benefits gained from these techniques to help boost the UK economy after the pandemic and stimulate the economy back to its prosperous level. Now you should know all 5 topics which were discussed in this international finance presentation.